In this Training Academy video, I'm going to show you, over the next 6 to 8 minutes, why you should know exactly how to read a crypto chart. Yes, watching to the end may make a big difference in this video. Let's get started. Now, understanding charts can literally take a lifetime to learn. So this will only be a high-level overview. It's important to know this information before ever investing. This should be part of your normal research for each crypto you want to purchase. Maybe you are looking at a regular token, or you want a professional broker for an ETF. You need to following along on a chart as they discuss a project or token you should look at. Yes, even Bitcoin. If you follow the herd, you may make some profit, like Bitcoin. In the next bull run, what's the best it'll go? Double? However, the real money is in the sleeper cryptos. Along with my first Academy training video on market capitalization, you'll be more knowledgeable than, say, 70% of investors who simply follow the herd with no research. Reading price charts is an essential skill in crypto investing, so it's crucial to know how to read crypto charts properly, especially for beginning investors who wish to start making profits on this crypto boon, and it's happening right now. So, today we're going to talk about crypto charts and explain to you what all those lines, numbers, and odd shapes are. Remember, this is only a high-level overview. Please consider taking an online course. You can find them for free here on YouTube. Time frames. What are they, and why is it important? Depending on your investment intention, you can choose to view a graph time span of 15 minutes, an hour, 24 hours the week, or finally from the start of a crypto project. It also reflects your trading style, and that's a good thing. See, day investors often concentrate on short periods, so they can make small profits within the same day. Now, swing investors may want to look at a longer duration, for example, a couple of days or a week to detect price moves. Maybe dollar cost averaging to cover losses if the token goes down. That would look like a red candle. It may also hedge your bet on that crypto, so do it sparingly. And finally, long-term investors may look at periods of months or years. Hopefully that represents the green candle. There are different ways to visualize crypto charts, so you should get familiar with all of them. However, for the purpose of this video, we will talk about candlesticks only like in this image. Now, don't fall asleep on me or click off this video. I promise it will make sense in a moment. The linear scale represents price changes in absolute values, while the log scale draws the reversal in percentages. Sometimes these two lines look a lot alike. The only difference is the vertical scale. The price in a linear chart is chopped off equally, while in log charts, the price scale is divided by percentage changes. With a little more training, you should be able to tell which one you're looking at. Log charts often set the default view, as it better reflects the trend and amplitude of the total price, and that's important. And you get this data from thousands of websites. Please use an honest site like cryptomarketcap.com. And we are off. Let's talk about the much-loved candlestick pattern. This is the easiest method of the many patterns. This is what I use almost every day along with the market capitalization, specifically when looking for sleeper cryptos I spoke of, especially when something happens in the financial market like putting tariffs on countries that are our neighbor. Charts are what you watch to find that buy signal. I'll show you why, with profits of over 1,000%. Don't believe me? Just watch for my proof. Candlestick charts provide more informative data, not only price moves and volumes, but also include the opening and closing price, the highest and lowest level in one session. It's so popular to see candlestick dashboards with subsequent columns full in green and red like this image. Green illustrates an uptrend, while red is for a downtrend. There are different types of candlesticks, but in this video I'm going to re-emphasize the most common patterns you'll see. The bull market has two typical candlesticks. These are called the hammer and the reverse hammer. You may want to write that down. Here's why. They are specified by green color, whereas in the hammer, the thick column lies on the top with the tail below, resembling an uptrend falling after a downtrend found in the image here. The reverse hammer has the thick column hung at the bottom, indicating a more stable uptrend throughout the session. Conversely, there are hanging mans and shooting star candlestick patterns, which symbol the bearish market. Market depth chart. In this chart, the green area indicates the number of coins and buy orders at that moment, while the red area shows the sell amount at that current price. The connecting point between the two sides is the current market price. Two basic indicators you might hear often are support and resistance. The support line is used to point out the bottom of a downtrend, in which the plunge is expected to bounce back and push the price back up. On the other hand, the resistance line refers to a level at the top, where an uptrend may defer. Technically, the support line indicates the lowest price, so traders can buy the dip to that moment in time, and resistance is the highest price in a bull market for doing that. After that, an inverted trend will take place, making the market balanced once again. See, I told you. Trust me, I know this is clear as mud. It is common and was exactly what I went through, but hold on, it gets easier. Next, we'll talk a little about moving averages. Simple moving averages are appropriate for showing the trending lines. This is done by connecting different averages and market price. See how this flows from one into the next. All parts of this chart are important, but keep your single focus until you master charting. Alright, good for you. You've already completed about 90% of this journey. Don't give up. You got this. Just like my company tagline, turning curiosity into knowledge. And now for the last 10%. Relative Strength Index. This specifies market momentum via overbought and oversold. In theory, when the RSI line crosses the upper or lower line, it blows a whistle that the market buying or selling orders are too much. Then the trend is probably going to rebound and push the price back to the balance level. Hence, when you see the market is in an overbought state, the RSI goes below 70. It is the signal to sell. On the other hand, when the market is oversold, the RSI exceeds 30, it's time to buy. As I promised, I've tried hard to make this very difficult journey of reading charts a bit easier by giving you only candlestick charts. This is what most of us investors use before we start drawing lines and looking in more depth. Explore on your own to learn what other types of charts do you find useful when trading. Congratulations, I'm proud of you for making through the whole training video. I truly am. I work hard to produce important information that people are asking for. If you have a question, please leave it in the comments section and I will respond to each request. I hope you enjoyed this video. You will see on the screen the first video in this Academy training series. Give it a watch. A final request, if you enjoyed this video, please make sure to like and subscribe to help me educate more people just like you who are asking for this information. Thanks my friends, and I will see you in the next video. Bye for now.